Hello, everyone. I'm Scott Sowell from AMVEST Capital. We're thrilled to have you join us for today's live webinar, Critical Minerals in the Trade War, Strategies for Market Positioning, brought to you by our team at AMVEST TERRADEN. A special thanks to our partners at Coherra for making this webcast possible. Before we dive in, quick disclaimer. This webinar is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as the basis for investment decision. And now let me introduce you to AMVEST TERRADEN, the driving force behind today's webinar. Our focus is on companies that explore, develop, and extract critical minerals. These minerals are not just resources, they are the building blocks of the technologies that are shaping our future. From defense to transportation, energy generation, and storage, these technologies span various sectors. What sets TERRADEN apart is our unwavering commitment to ESG compliance. We exclusively support companies operating within the Western value chain, ensuring they are not tied to Chinese or Russian interests. This approach aligns with our dedication to sustainability and responsible resourcing. Joining me today are my esteemed colleagues, Stuart Macliver and Tomasz Nadrowski, co-founders of AMVEST TERRADEN. Their extensive knowledge and combined experience in natural resource investments make them the perfect guides for today's discussion. Stuart is not only co-founder of AMVEST TERRADEN, but also the managing partner of AMVEST Capital, a New York-based specialist investment management and corporate finance firm dedicated solely to the natural resources sector. Based in New York, Stuart combines his finance and geology expertise to evaluate natural resource opportunities from both technical and financial perspectives. With extensive experience in corporate advisory and transaction, Stuart has worked across M&A, equity and debt capital markets in the natural resource sector. He holds a Bachelor of Commerce from the University of Western Australia, is a member of the Institute of Chartered Accountants in Australia, and has a graduate diploma in geology from the Western Australian School of Mines. His unique blend of financial acumen and geological knowledge make him a valuable resource in understanding the economic and environmental implications of critical minerals. Also joining us is Tomasz Nadrowski, our portfolio manager. He's a seasoned expert in mining investments with over 25 years of global experience. His career includes roles as portfolio manager, commodity strategist, and commodity analyst at various firms across North America, London, the Netherlands, and Johannesburg. Tomasz is a former director of the World Economic Forum, holds a CFA charter, and is fluent in 7 languages. He earned advanced degrees from the School of Economics and Social Sciences and the University of Geneva. The global race for critical minerals is reshaping the balance of economic and political power. On one side, we see the U.S. working to strengthen supply chains and reduce dependence on foreign-controlled resources. On the other, China continues to assert its dominance, leveraging its control over critical minerals as a cornerstone of its global strategy. The sector is about much more than just economics. It's a battleground for competing industrial policies, trade strategies, and geopolitical leverage. The decisions being made now will ripple through the markets, industries, and global relations for years to come. And that's why today's discussion is so vital. Together, Tomasz and Stuart will unpack the complexities of this rapidly evolving landscape. From China's strategies to the challenges facing Western governments, they'll share insights on how the critical minerals sector is evolving and what that means for industries, markets, and investors. Today, we'll dive into the dynamics of the sector, and a few of the topics that we'll cover will include trade and retaliation of critical minerals, the West versus China, conflict or competition, industrial strategy, minerals and statism, old and new investment playbooks, and some case studies looking especially at Ukraine and Greenland. This is an incredibly timely and high-stakes topic, and we hope you will leave with some actionable insights to how you can navigate this rapidly evolving space. Following the formal presentation, we will open the floor for questions, so please submit them as we go through, and I'll try to ask them on your behalf in real time. And with that, I'll turn the floor over to Tomasz.
Thank you, Scott, and thank you everyone for joining us this morning or afternoon. Of course, trade wars is a very topical theme, grabbing the headlines the last couple of days, and we will allude to this, although maybe not exactly from the angle that you might expect. We understand the interest, of course, and we'd like to focus today specifically on the critical minerals dimension of this problem. And so some of what you hear from me, at least today, is drawn from material for the book that I'm writing entitled Mineral Wars. This will be out probably late spring. So if after this webinar you're still interested in this topic, look out for this title sometime later this year. So trade wars, this could have entered our vocabulary, daily vocabulary, since around 2018. This is a time where the first Trump administration endeavored to compensate for significant trade distortions that have crept into the global system, essentially since China's admission to the WTO. And despite efforts of the successive governments, both in US and EU, this problem has been further exacerbated in recent years. This was marked, for example, in 2024 by current account surplus that China registered of about $1 trillion, a record current account surplus. And so we have to dissociate two things. First, it's good for an economy to export because exports foster high-end competitive industries. They increase the value of the labor force and, of course, allow for importing of products which are not produced in the exporting economy or which are produced more efficiently somewhere else. But that's exports, not current account surpluses. Chronic current account surpluses are a problem. They betray chronically weak demand in the exporting country and mean that essentially the exporting country has to borrow demand from overseas. And this is exactly what's happening in this case. It's particularly interesting when you look at it from raw materials perspective and critical materials among them, because the only countries that actually enjoy current account surplus, bilateral surplus vis-a-vis China, are commodity exporters, so say Saudi Arabia, Iran, or Turkmenistan, and on the mining side, Chile, Australia, and Brazil. The only other countries that have a current account surplus with China are producers of high-end technology: South Korea, Taiwan, Japan, Germany, Netherlands, and Switzerland. And so we have those trade frictions and different responses to trade pressure from the United States have been observed over the years by other countries which were in conflict. For example, in 1990s, Japan was under significant pressure from Washington and decided to self-impose itself voluntary export restrictions, VERs. Other countries solved this dilemma by importing armaments, weaponry from the United States. This, of course, the case of Saudi Arabia, Israel, Taiwan, Japan, or Australia. But China doesn't have these options. China, first, will not restrain itself for exports. Restraint is not something that characterizes Chinese diplomacy, economic or otherwise. And of course, it won't have access to US-made weaponry. So let's just have a look at what China can do and what minerals, what kind of role minerals can play in this trade war. So first and foremost, since China has a very sizable trade surplus bilateral vis-a-vis the United States, it cannot really retaliate tit for tat, right? So with 10% tariffs imposed on China the other day, of course, Beijing cannot help itself. It imposes tariffs on certain products, energy products, as we saw. In 2018, these were soybeans. The soybean card is not really such a good tool for Beijing anymore because Chinese pigs, which consume soybeans, have been now addicted to Brazilian imports from Brazil. So there's less dependence on the US markets. But overall, if you run a significant current account surplus, the tit for tat retaliation is not really the way to go because, of course, you're going to lose. So what are those asymmetric forms of retaliation? Well, there's a lot of talk about, for example, China selling its overhang of US treasuries. In our view, this is a bit of a nothing burger. China holds about 736 billion US dollars worth of US treasuries. This is an amount that was cleared by the Fed during COVID within just 6 months, and that was at very low interest rates. We have much higher interest rates, so it's very possible that this overhang will be cleared with the help of private buyers, not least the pension funds from Japan or somewhere else. Another argument that China has is to block some US companies from access to the Chinese market. companies such as Apple, Tesla, or Microsoft. And indeed, they have a track record of lobbying on behalf of Beijing and Washington. So that could very well happen. China could also try and peel off some of the U.S. allies. In this case, the Trump administration is actually helping China because with this wrecking ball of tariffs directed at U.S. allies, it's possible that some countries which believe that they have a choice might actually deepen their relationship with China. And then there is the nuclear option, which is the depreciation of renminbi. This is what China did in 2018, allowed renminbi to depreciate by 13%. And we have noticed an offshore renminbi that has depreciated by about 3% since the US election in November last year. The problem with this tool is, however, that it's not bespoke. Of course, it doesn't just affect the United States, it affects all of the trade partners, China's trade partners. And here one has to say that Xi Jinping has invested quite considerable personal prestige in the relationship with Global South, the countries of Global South, with some of them which have now already trade frictions with China over aluminum, steel, or electric vehicles, and so on. So this is a potentially strategically an own goal, which leaves us with critical minerals. And critical minerals are a possible source of leverage for China, not only vis-a-vis the United States, but also Japan, Korea, and others, because China is a leading producer of about 20 of those minerals. So let us ask first, what are those critical minerals? What makes them critical? Well, first and foremost, many of them are quite broadly distributed around the planet. However, that does not necessarily translate into production. Often some of these minerals are produced from 2, 3, 4, sometimes even one major mining operation. Very often they're produced also as a byproduct of metallurgical processing. And so the criticality is defined by what one former Nobel Prize winner defined, the viewpoint. And the viewpoint depends on your sitting point, where you're sitting. It didn't matter so much when you were sitting during the liberal 30 years of globalization, because geography and geology was not that determinant. What you didn't have, you could source from the market. And of course, the larger the land mass, the higher the probability that you'll find something domestically. However, that's not the world that we're living in now. We're living in a world of insecurity of supply, and insecurity shortens timelines. And therefore, it's not just the potential access to minerals that matters, but actual access. And therefore, it's not just geography and geology, but the strategy, the response of the different countries and different regions to the problem of insecurity of supply of the critical minerals. And although the problem has been known at least since COVID, different countries have provided different answers. There's different sense of different level of sense of urgency, of vulnerability, and of course, execution differs quite a bit as well. So let's have a look at those different responses, starting with the United States. So U.S., of course, the cornerstone of the liberal order based on free flow of goods. The country has, however, had a fragmentary stockpiling system, fragmentary at least since the end of Cold War. It was established in 1939, the National Defense Stockpile, established by Franklin Delano Roosevelt. And in the 50s, the stockpile was worth $50 billion. By the time we get to Ronald Reagan, it was only $15 billion. Today, the stockpile is worth around $500 million. So that kind of illustrates the reliance of the U.S. system on trade flows, free flows of goods and factors. A good example is, for example, a couple of years ago, many companies were investing in gigafactories in the United States. Very little thought was spurred to where exactly the mineral inputs into those gigafactories would come from. Now, Europe's history is different. Europe is just basically a small peninsula on the Eurasian landmass, historically almost always threatened from the east, from the nomadic Huns to ideological Soviets. And the Soviet history really matters because when Willy Brandt opened Ostpolitik and opened up to relations with the Soviet Union and strengthened the economic relations, Soviets reacted to this by devising a strategy to ensnare Western Europe and dependence on fossil fuels from the Soviet Union. That was generated in the mid-80s. The USSR ran out of time to apply it. Vladimir Putin dusted off this playbook and applied it masterfully since roughly 2003, the Yukos takeover. Now, the minerals did not play a main role here. However, Russian metals, nickel, aluminum, and copper dominated very often the warehouses of London Metals Exchange. And this process, those 30 years, also coincided with the slow demise of mining industry in Europe. Of course, the sense of vulnerability in Europe, both in terms of fossil fuels and minerals, changed radically exactly 3 years ago when Russia invaded Ukraine. Then we have Australia. Australia's response is more nuanced because it's a large commodity exporter and very independent with the world's largest commodity importer, that is China. However, even though this interdependence is mutual, we detect elements in the Beijing strategy to wean themselves, to make themselves independent of that very heavy dependence, especially on high-quality iron ore in Australia. Now, I don't see a strategic response from Canberra for the day after Simandou in Guinea, after some other projects that China is pursuing to make itself more independent. And I'm mentioning iron ore because actually on the list of critical minerals devised by Beijing, iron ore belongs to this category. It's considered critical mineral for China, quite uniquely. Canada's dependence on market access to China has always been less than Australia. You can see it, for example, in the way the Canadian dollar trades compared to the Australian dollar and how it responds to ups and downs of the Chinese economy. And that's for several reasons. Of course, Canada's geography, its commodity mix, and its proximity to the U.S. market make it a very different commodity exporter. But Canada, of course, noticed several years ago from the rising tensions between Beijing and Washington that critical minerals are both an opportunity and a threat, as we heard in recent days from the various pronouncements by Canadian politicians in response to the threats from Washington. Japan always geologically poor, very dependent on imports, and that led during the Meiji era in 19th century to some catastrophic strategic decisions by Japan. But post-1945, Japan basically decided to piggyback on U.S. naval primacy in Western Pacific and its control of the trade flows, all the way until roughly Obama administration. Obama administration didn't pay much attention to the territorial conflict between Japan and China and East China Sea. And the late Prime Minister Shinzo Abe devised a new grand strategy for the country, which is much more assertive, and where critical minerals play an important role, both from perspective of stockpiling, recycling, and also race towards substitution of the minerals that are critical for the Japanese economy. And then China. Well, China is different because China has two types of critical minerals. It has those in which it is deficient as any other industrial economy, but also those that it can leverage by manipulating access, availability of those critical minerals for its strategic advantage. Now, these policies, as we'll see in a moment, range from flooding the market to disincentivize investment in the West, to constraining outflow of those minerals and promoting just flow to friendly countries, say Hungary in Europe, or to Chinese companies operating overseas. And then since 2015, since the Made in China 2025 strategy of a large-scale import substitution, the drive has been to embed critical minerals within vertically controlled value chains, so that rather than exporting unprocessed or half-processed intermediate goods, China concentrates on exporting finite goods, and in which critical minerals' role is exactly the same as other inputs: cheap energy, cheap labor, low cost of capital, and also very affordable critical minerals. Okay, so now to understand what it means for us, we have to actually step back a little bit, because we in our free market liberal world here in New York City and many other centers around the world, we have this cognitive filter where we see markets, including commodity markets, as sort of an arena of competition. Now, the Chinese Communist Party doesn't look at it this way. Its view is that this is not really competition, but conflict. There are avid readers of an important German philosopher, 20th century political philosopher. His name was Carl Schmitt. He was a member of the Nazi Party. But different factions of the CCP read Schmitt, and they like especially his criticism of the liberal order. Schmitt mocked liberalism, saying that it fails to distinguish between friend and enemy, between friend and foe. And therefore, sooner or later, liberal states succumb to either internal strife, now think about wokeism and anti-wokeism and all this nonsense, or succumb to pressure from external entities which are much more politically united. And so 12 years ago, when Xi Jinping came to power, he had this speech based on his document number 9, in which he very clearly defined the West as an enemy, ideological enemy, free market, free media, separation of powers, and so on. So no such doubts in the case of the Chinese Communist Party. Now, this does not mean that this conflict disintegrates into resource wars. This is a red herring. That's not how things function. I mean, honestly, that betrays probably poor knowledge of history, because there are very few cases of kinetic wars over resources. Really, in the last 150 years, I can maybe find 3 examples. The first example would be, of course, Japan and Manchuria. Japan, poorly endowed with commodities, trying to vie for control over Manchuria against first Tsarist Russia and then Soviet Russia, because of metallurgical coal and iron ore that was available there, and also settling peasants in Manchuria. The second example is, of course, Adolf Hitler's invasion of Ukraine in 1941, which was a colonial endeavor to resettle German peasants on Black Earth land in Ukraine. But then beyond this, he was ogling the oil fields of Soviet Azerbaijan. And the third example is Saddam Hussein, of course, who attempted to control Ahvaz region of Iran over a bloody war that lasted for 8 years because of oil deposits there that the British discovered in 1920s. And then when he failed, he tried something similar in Kuwait. So only 3 examples in 150 years. There may be other resources that are more amenable to zero-sum game. Water, great example. Mining investors know of problems in Bolivia, Peru, Chile, wherever water is scarce, that it leads to conflicts. But it's very unlikely to see it in other resources. So yes, it's a conflict, but it's not a hot conflict, or at least if there is kinetic conflict between the West and China, this is not the main reason for that. Having said that, we have to pay attention to how the market is structured. Because if we meaning we investors, we Rio Tintos, Glencores, BHPs, Freeports, and so on, are still looking at it from the perspective of competition, but the other sides, a very dominant consumer and producer of many of these commodities, sees as a conflict, then we have certain distortions in the market. We should pay attention to this, because statist policy influences markets in a very specific way. So let's have a look at these, because it's really important that we understand these dimensions. And there are 4 different angles. Now, first is the different emphasis on stocks versus flows. Authoritarians in general are not comfortable with flows, especially flows that they don't control, such as global trade flows. They prefer stocks. They're more obsessed about security than about profitability. Therefore, relying on security of stocks is something that's really important. In the communist case, they consider commodities means of production, and of course, control of the means of production secures power. In China, it had a long history, pre-communist history, about Mao Zedong considered self-reliance a virtue, Zili Ganshan, and this term, Zili Ganshan, was picked up by Xi Jinping and dusted off, and especially you saw it when State Reserve Bureau, which used to stockpile metals, was merged with the State Grain Bureau in 2018 under NDRC, the super ministry under the State Council. It's important because these are large stockpiles. These stockpiles are used also for manipulation of prices, but they are a state secret. So the result of that focus on large stockpiles is that we have actually fairly poor visibility of what's there, what is the overhang over the market. So that's the first dimension. The second dimension is the different emphasis on supply versus consumption. Now, authoritarians in general are not interested in boosting consumption, but in boosting supply side of the economy for many reasons. Both on the Nazi and communist side, production is virtuous, especially production of widgets, and widgets are often made of metals. And consumption is somewhat frivolous. So it's the opposite of, say, Adam Smith. And this is exactly the opposite of the U.S. is doing. When Joe Biden introduced Inflation Reduction Act in 2022, what did he do? Well, he introduced tax credits for consumers, for buyers of EV. But if you have an economy that constantly uses every single fiscal project to foster supply rather than consumption, you end up with overproduction and overcapacity. And that's a problem because, of course, it leads to very chronic deflationary trends. The third angle is different emphasis on the P&L, profit and loss account, income statement. Of course, private companies always look at the bottom line. This is what it's all about. State-owned enterprises look differently. So state-owned enterprises in mining and metallurgy very dominant because usually the upstream of various value chains in China are dominated by the state ownership. They tend to focus on the revenue line, not profit. And as a result, if prices go up, they produce less. If prices go down, they produce more because they have to keep the revenue stable, because they have different commitments, sometimes social commitments in specific locality that they have to live up to. The result of this are extreme price swings, as we have seen in many commodities and many critical minerals recently. So much higher volatility in these markets. And finally, one more angle is the speed. Now, as mining investors, we often agonize about how long it takes to permit a mine. For a large open pit copper mine, probably 15 years since discovery to production. Authoritarians don't have this problem. They don't have to deal with, of course, they don't have to deal with local opposition or NGOs or what have you. And they are capable of shortening the timelines quite significantly. I think the biggest shock we had in the last couple of years is Chinese lithium investors in Zimbabwe, who could actually bring the product off the ground within 3 or 4 years, boosting it right now, by the way. So different duration and different responsiveness to the market. So does it mean the statism has already won? Well, maybe not. Zhou Enlai, when he was asked in the 1960s what he thought about French Revolution, he said it was too early to say. It's true that statism in China fell on fertile ground because even in imperial China, merchants were considered low class. So there was this system of 4 class, Shinong, Gongchang, Shan are the traders or merchants, right? And they were despised by Confucian mandarins, and they were despised by the communist apparatchiks as well. But the whole idea of mercantilism came from Europe, like many other things. In 17th century, Jean-Baptiste Colbert in France viewed the role of state as interventionist. So states should intervene in the economy to increase the country's wealth. Some 150 years later, Friedrich List, a German thinker, launched an economic theory, which is the opposite of Adam Smith and David Ricardo, nationalism and statism. So state should support domestic industries. And this system contributed to the development of German modernization, industrialization in the late 19th century, as well as Japan, which copied Germany. And through Japan, the Japanese two dependencies, South Korea back then, and Taiwan. And finally, in the 20th century, we have, of course, the Bolsheviks who come and they monopolize foreign trade. This was, by the way, the best job you could get in the USSR, working in foreign trade, because you had access to Western goods. You could also travel and see the world, which other Homo Sovieticus couldn't. But they also monopolized each sector. So basically one big company in each sector. That's not what the Chinese did. They pulled the leaf from the playbook of Park Chung-hee, the dictator of South Korea in the 60s, who allowed for almost Darwinian level competition within spaces defined by the state. And we see this in China. 5 years ago, there were 500 EV producers. There are about 70 now, and of course, this number will dwindle. However, the level of that control, state control, increases the great financial crisis, because what really matters for the regime is stability. And they fear that liberal systems such as the U.S., and you might remember the unemployment in early 2009 in this country, is not something that's acceptable to a regime which cannot be replaced by definition. So it's easy to see such comparisons in the past, for example, between the Great Depression in the United States, 1931, and how well Italy went through it with Mussolini's proto-corporatism. There was barely any crisis there. Okay, so now let's have a look at this, what Katherine Tai called monopolistic industrial strategy. Katherine Tai was Joe Biden's U.S. trade representative. And I think this term probably is a bit too narrow. Yes, that's true. There is industrial strategy. The first industrial strategy, modern industrial strategy, was launched in China in 2006, and then it accelerated after 2015. It means that a lot of phenomena you see in the market are artificially generated, whether it's scarcity or glut. Now, how does this system work? Well, first and foremost, you have to depress the capital costs. So keep interest rates way below the GDP, way below inflation rate, and incentivize domestic overinvestment. Now, overinvestment where? Well, not in mining, actually, in midstream metallurgy. massive capacity build out, regardless of demand. It's like building infrastructure in China. You build, you supply, and you hope that demand will come. Sometimes it does, sometimes it doesn't. Steel, aluminum, and then other minerals as well, including critical minerals. Only then do you secure the mining feedstock for that metallurgical sector, reluctantly from the global traded markets. When China started growing, it had to fit into the global copper market, which was very financialized, or iron ore market, which was very dominated by 3 and then 4 suppliers. So preferably, they want to either control equity overseas, so control mining operation overseas, or if that's not possible, consolidate the midstream to exercise this oligopsonic dominance in the market. Then you flood the market with the commodities, the survival of the cheapest. The other day, the CEO of China Moly, CMOC, a very large cobalt and copper producer, and not least in the Congo, complained about Indonesia's cobalt production, which is a byproduct of nickel production in Indonesia, saying they're producing too much. And what did his company do beginning of 2025? Well, they decided to flood the market with more cobalt this year. So survival of the cheapest. You just hope that others will die on the way and you gain more market share. In the meantime, you protect the margins of midstream and downstream producers who use those cheap inputs, cheap metal inputs, example, lithium converters, for example, and you hold down the commodity price, undercut the competition, and disincentivize this foreign investment in upstream capacity ex-China. Classic example, of course, is rare earths. You also keep the processing technology onshore. You prevent this metallurgical technology from leaking overseas. This is called bottleneck strategy. Very common, for example, in graphite, where China controls SPG technology, so spherical graphite, spheronization of graphite. Korean anode producers, and anodes need SPG, are basically dependent on that. And we saw POSCO Future M, Korean anode producer, halving its production going forward because they cannot obtain SPG from China in sufficient volumes. And then you control exports of raw materials and intermediate products. Just this week, almost a couple of hours ago, China decided to use the dual use regulation of the Nuclear Non-Proliferation Treaty to potentially embargo exports of various rare metal compounds and alloys based on bismuth and tellurium and molybdenum and so on, affecting predominantly other Asian industrialized countries such as our allies in Japan and Korea. And then finally, instead of favoring exports of those materials, unprocessed or half-processed materials, you're of course trying to promote exports of value-added consumer products, and then flooding the global market with EVs or drones or solar panels and so on. Now, of course, this approach will vary. It will differ depending on how, to what extent China can control different nodes in the value chain. So it will depend first on the geological endowment. If China is very well endowed with the mineral, as the case on tungsten or antimony or earths or germanium, then of course it can exercise oligopolistic leverage. But when it's not the case and it builds up from the beginning this very large metallurgical base, then it can concentrate production. That's the case of graphite and gallium and scandium and nickel, increasingly also copper and aluminum. So that allows them to consolidate and have oligopsonic leverage. And finally, the third sort of dimension is when the Chinese companies come to dominate the mining and early processing sector in a foreign country. That's the case of cobalt in Congo, manganese in Gabon, nickel in Indonesia, and increasingly lithium in Zimbabwe. So what are really the lessons for investors in this? Well, first, I'll give you a lesson on what not to do. So investors in junior mining over many years were trying to identify companies that would find a comfortable exit. That is, that they would be sold to a major tier 1, tier 2 mining company. Since 2011, Western companies so focused on IRR have not been extremely active in this space. And so Chinese companies filled this space. And it was a certain complementarity, especially between exploration and successful exploration development juniors on the one hand, and Chinese companies, including state-owned companies. Why? Because the Chinese companies are not particularly good at long lead exploration progress in exotic jurisdictions, but they have access to non-cyclical or counter-cyclical capital. And so there was a certain acquisition premium on juniors, and of course, possible exit for them as they could be acquired with their asset by Chinese companies. Now, this acquisition premium is gone. And it's interesting because we're speaking about it on February 4th, 2025. And if I were to mark the death knell to that investment strategy, it was exactly 3 years ago. Because exactly 3 years ago, Zijin Mining, a company from Fujian, predominantly privately owned on the equity side, acquired Neolithium, a Canadian company with significant lithium asset in Argentina. Now, what happened on the same day? Well, Xi Jinping and Vladimir Putin signed no limits partnership. And 2.5 weeks later, Russia invaded its neighbor. A couple of months later, Canada updated Investment Canada Act, basically meaning that Neolithium sale to the Chinese company was the last sale of this type. That is a critical mineral controlling Canadian domiciled company selling its asset into a Chinese entity, even though the asset itself may be in another jurisdiction. The company itself is Canadian, and Australian FIRB, Foreign Investment Review Board, has taken a similarly strong position on that. So betting on Junior's exit is no longer a viable investment strategy. So the question is, what is? And I think we can sort of draw an event tree, because what it means that we have to actually take our heads outside of our mining ghetto, which is often what we do. We certainly do it as gold investors, right? We don't really care so much what happens downstream from exploration, development, and mining. Here, you have to look a little bit vertically and horizontally away from the hole in the ground. First thing, you have to find out where China and Russia retain an edge. And it's actually quite a long list of about 25 different commodity markets. And then you have to narrow it down. How do you narrow it down? This is where you have to develop interest in the end markets. That commodity selection will depend on technological changes. So you're not looking at technology now, you're looking at future technology. I mean, what's going to leapfrog? So if your hobby is defense, you're not looking at RTX and Lockheed's material needs, but you're looking at Anduril and Palantir's material needs, right? If you're interested in semiconductors, it's probably not your mother's or father's or grandfather's silicon. It's going to be gallium nitride or silicon carbide. And if you're looking at anodes, probably less graphite, more niobium. The second thing you do, you have to look for assets that allow to broaden the production base, because as I mentioned, very often, too often, especially those miners minerals are dependent on just one or two or three major viable production source, and it's often in jurisdictions that are either unpalatable or on the other side of the geopolitical divide. So current examples are, for example, boron, fluorspar, bismuth, niobium, beryllium, high purity quartz, dysprosium, indium, rhenium. There are a couple of others. And then exclusion lists. There are a couple of jurisdictions that really have become no-go zone. Obviously, gold investors know about what's happening in Sahel. Uranium investors know about what's happening in Sahel. Lithium investors know what's happening in Sahel. And some executives of these companies know the very hard way. Certain places simply no-go zones. You're not going to invest in mining in Indonesia if you have to build a smelter at $2.5 billion. So the other thing you have to pay attention to is that some of these minor metals can be extracted either from slag or from smelter production, like vanadium, scandium, rhenium, gallium, germanium, tellurium, by just tweaking the production process of steel, zinc, molybdenum, alumina, or copper. So that might reduce the attractiveness of upstream, long lead upstream projects. And then, and Stuart will allude to this in a moment, there's the geographic optionality. In this division between China and the West, there is a number of countries that are kind of sitting on the fence for various reasons. Fence sitters might bring actually the highest returns going forward. And a good example in oil and gas is actually Guyana. Guyana has been able to attract both American and Chinese capital, and that makes the country relatively safe from Maduro's designs from Venezuela. But, in mining, Saudi Arabia is emerging as a new kind of mining frontier. Greenland and Ukraine could be in many other ways. And when you do this, you have to look at the technological progress to develop non-conventional deposits. Who knows, maybe those porous limestone formations in Texas and Arkansas will be eventually viable for lithium if oil and gas companies progress there. And finally, project timelines. Project timelines matter. Sometimes you have those big belts extending across different jurisdictions, so it's important to look at the timelines. Classic example here, if you look at lithium in Argentina, it's very different to do it in Salta, Catamarca, or Jujuy, even though this is all one geological region. And last but not least, financeability. In these markets, financing matters. It's difficult. Commercial banks are not necessarily very gung-ho on that. So the structure of the downstream business matters. So I spoke about technology. How well funded are companies downstream? Do they have project financing desks? If not, do they have any experience in doing this? Are there any unconventional fund allocators, private or public? Because if not, you may get stuck on something for many years. There are multiple examples here that projects just simply cannot find sufficient funding to get through the finishing line. And so then you establish the scale that you enjoy in the IRR cutoff, and here you are. That's probably the best you can get in critical minerals right now. So I leave it now to Stuart, who will speak of two emerging jurisdictions and what's of interest there for potential investors.
Thanks, Tomasz. In my section, I'll be discussing the conflict in Ukraine and then the renewed interest in Greenland. And in our opinion, all these things, sometimes there can be more than meets the eye, and people should be thinking about the natural resource endowment of the country. So Ukraine's home to a vast array of critical minerals with an estimated value in excess of 26 trillion US dollars, making it a significant player in the global supply chain. Ukraine ranks among the global leaders in reserves of coal, iron ore, natural gas, manganese, salt, oil, graphite, sulfur, kaolin, titanium, nickel, magnesium, timber, and mercury. We don't have time today to examine the importance of Ukraine's agricultural endowment, but it's quite significant. Putin and the elites around him do not believe that Ukraine deserves existence as a fully sovereign entity. Moscow's plans go beyond Ukraine and involve a buffer zone in Central Europe, separating Russia from the West. However, with all its natural resources, one must wonder if this was another main job of Putin. Notice on this image on the right, the valley of minerals in eastern Ukraine. Ukraine enjoys a globally high ranking in several minerals. Ukraine has approximately 20,000 mineral deposits covering 116 types of minerals, including Europe's largest titanium reserves, which account for 7% of global titanium reserves. It also has significant lithium, beryllium, manganese, uranium, and graphite deposits. These resources are critical for advanced industries, including defense and technology. Before the war, metal and mining and processing contributed 2.9% of Ukraine's GDP and accounted for around 9.5% of its exports. Ukraine was a key global producer of ilmenite, which is a predecessor to titanium, rutile, manganese, kaolin, and iron ore, ranking 14th in global steel production. Many of Ukraine's critical mineral deposits are in contested regions, such as Donetsk and Zaporizhia, which are partly occupied by Russian forces. Russia has extensive Soviet-era data on Ukraine's mineral wealth, underscoring its strategic interest in these resources. Despite the war, Ukraine is moving forward with privatization efforts, including the UMCC Titanium Company, which was a major global supplier of titanium raw minerals. This shift could open up investment opportunities, but it also carries geopolitical implications. The strategic importance of Ukraine's critical minerals to Russia and globally cannot be overstated. Even yesterday, US President Donald Trump said he wants Ukraine to supply the United States with rare earths as a form of payment for financially supporting the country's war efforts against Russia. Ukraine's critical minerals are essential for defense, aerospace, high-tech industries, and new energy technologies. With global demand rising, Ukraine's resources are crucial for diversifying supply chains away from China and other non-democratic regimes. Ukraine's vast mineral wealth makes it a strategic asset, particularly as Russia controls parts of these key mining regions like Donetsk and Zaporizhia. Moscow has extensive Soviet-era geological data on Ukraine's subsoil, making these resources a potential economic and military advantage in the ongoing conflict. The EU and the US recognize Ukraine's role in securing critical minerals, and they have developed strategies to integrate Ukraine into their supply chains. The EU-Ukrainian Strategic Partnership on Critical Minerals from 2021 aims to reduce Europe's reliance on external suppliers by developing 100 mining projects focused on 10 key minerals. Ukraine is actively auctioning exploration permits and privatizing state-owned enterprises, like I previously mentioned, the United Mining and Chemical Company, a major titanium producer. While mineral extraction offers economic and security benefits, sustainable mining practices are critical to mitigating environmental risks. Ukraine and its international partners are working to ensure responsible development, balancing economic gains with ecological concerns. Now on to Greenland, which is not just the next Mara igloo. Greenland holds the 8th largest reserves of rare earths globally, with an estimated 1.5 million metric tons of rare earth oxides. This is comparable to the 1.8 million metric tons of rare earths in the US. The Kringlerne rare earth deposit in South Greenland is among the largest globally. Greenland is also rich in 25 of the 34 critical raw materials identified by the European Commission. The Disco Nuswak project could rival Siberia's Norilsk Talnak, one of the world's biggest nickel and copper miners. The country is also prospective for offshore oil and gas fields. However, new drilling has been banned. Now, does Greenland have a mining industry? Well, there are only 2 operating mines, and there are many challenges to mining in Greenland, despite having a well-documented mineral reserve. The climate is harsh, and the northern coastline is covered in sea ice for much of the year. Greenland's remoteness and harsh climate make it difficult to mine with a lack of infrastructure. Greenland also has a very limited available workforce to participate in the mining industry, with a population of only 57,000 people. So the 2 operating mines, Lumina produces a north site, which is used to make rock wool insulation, and Greenland Ruby produces rubies and pink sapphires. 2 real industrial mines. There are 2 other assets you can see in the chart, but 2 I will highlight, which just adds on to like the timelines and who owns these types of companies. So there's an ASX listed Ironbark, which is developing the Citronen zinc lead project. Interestingly, this was formerly backed by a Chinese state-owned enterprise. In 2021, however, Ironbark unveiled a $657 million US funding deal with the US XCIM Bank under the US government's Lender Special 402A program, which aims to help companies compete with China with projects to sell their product to the West. And there's also the Tanbreeze Rare Earth Project. It's owned by a NASDAQ and Australian listed company. This asset was first discovered in the 1800s. However, the licenses have been owned and advanced by the same group of people for the last 20 years. China has been active in Greenland since 2012, and it remains one of Greenland's biggest trading partners. Interestingly, in 2013, the Greenland Parliament changed its mining policy and opened up applications for exploration concessions. And you saw from 2014 onwards that the Chinese started becoming involved in mining and infrastructure projects here. The Greenland economy is highly dependent on 2 sources of income. The first is an annual block transfer from the Danish government worth about $500 to $600 million a year. And the second is fishing. The fishing sector counts for 93% of Greenland's exports. Still, China remains one of Greenland's biggest trade partners today. And for now, it is the only purchaser of the island's exports of seafood, ice, water, and sealskin, that bring the 2 closer together. In 2020, Greenland exported approximately 1.3 billion kroners of seafood products to China. In 2016, for instance, a Hong Kong-based company had shown an interest in acquiring a decommissioned Danish naval base, while in 2018, a Chinese state-owned company bid to extend and modernize the runways at Greenland airports. Both these initiatives were ultimately blocked by Denmark. The United States has paid little attention to the Arctic for several decades until 2019, attempting to counter Russian and Chinese commercial military buildup. Interestingly, the US has previously tried to buy Greenland 3 times, Back in the 1940s, the US offered Denmark $100 million US, about $1 billion today, in gold bullion for Greenland. US Senator Owen Brewster said that he considered buying the island a military necessity. The US ended up getting its military bases it wanted anyway. Greenland more recently gained international attention in 2019 when former President Donald Trump tried to buy the island. In 2021, the US opened a consulate in Greenland, where it for decades has had a military base that is vital to its ballistic missile early warning system. Greenland elected a new government in April 2021 that has pledged to halt a large Chinese-backed rare earth mining project because it contains radioactive uranium. The project was seen as a potential game changer for the country's tiny economy. Washington has a military base on Greenland. First was developed in 1951, and then the second was developed in 1959. Some of these operations have been turned into space activities. And now I'll pass on to my colleague Scott for some questions.
Thank you both. Really insightful presentation. And just a reminder, as we move on to audience questions, we have had a few submitted, but certainly continue to do so using the questions tab. I'm sure this could be a webinar unto itself, but one of the ones that have come in is, what impact will Trump's tariffs have on the U.S. being able to import critical minerals from Canada and China, two leading exporters of critical metals?
Okay, let me just try to respond to this one. The conflict between this administration and Canada is probably only secondarily about trade. The tariffs are being used to solve other issues. And it would be very surprising if it was about trade, because the structure of the trade between U.S. and Canada is the result of agreements, starting with 1965 Ottawa Parts Agreement, and then of course through NAFTA in 95, 96, and USMCA under the first Trump administration. Critical minerals, and not only critical minerals, but also fertilizers, energy, fossil fuels, aluminum, and car making would suffer hugely from disruption here. So I would be very surprised if there is no negotiating settlement found for the current conflict. With China, it's different because China has agency, has shown it has an agency, and has shown that it's willing to deploy significant resources to build industrial capacity and overcapacity in this case. And therefore, it's important to look at intentionality when you approach trade conflicts. Why do we have this status quo? Where it's coming from? What's the origin of that? It seems to me that critical minerals as such, so trade in critical minerals, is of lesser importance. U.S. is dependent on, say, magnets from China, much more than rare earths from China. The reason being, we just don't have magnet production onshore. So what's the point of digging rare earths, whether locally or in Greenland, in order to process this in China and then bring it back in the form of a magnet from China? So the problem is much more further down the value chain. This is something that the Chinese industrial policy understands. I don't think successive U.S. administrations understand it very well.
What changes in policy will bring up the Trump administration, and what do we what can we expect in the coming months?
So it's probably too early. There's so much noise. It's a broad question too. One thing we obviously see is the administration is trying to ditch all the policies introduced by the Biden administration. IRA is one of them. The U.S. CHIP Act will be more difficult. It's too much of national security issues hinge on survival of that bill in some form or another. What we heard during the transition, though, is that rather than focusing on the consumer and the tax credits for, say, buyers of EVs and solar panels and so on, the focus will be à la chinoise on the supply side. We haven't seen it yet. We don't know whether there is going to be a proper reindustrialization policy, because for this you need to harness significant resources. You need to have a blue-collar worker development scheme, apprenticeship, like in Germany or in Switzerland. I don't see that, and with a commitment to get rid of significant numbers of cheap labor, however illegal it may be, it doesn't seem to me like we're building the base to reindustrialize country and compete on costs. So it's really difficult to say right now. And of course, the idea of slapping tariffs at our allies, for example, in Asia, so the three countries that have not lost manufacturing, Japan, Taiwan, and South Korea, in the hope of bringing these investments onshore, it's a bit of a white goose chase, precisely because they have already invested to the tune of tens of billions of dollars during the previous 4 years. Secondarily, if you actually slap high tariffs to suddenly redevelop these businesses here, you'll have to bring those people here. You'll have to bring all of those Asians and hundreds of thousands of engineers and technicians, because we just don't have people to man it. So I'm not sure exactly what the approach will be. I think it's still a work in progress.
I'll just add on to that, like in the US, 70% of the oil that the US refines is imported from Canada and Mexico. And so some regions of the US are 100% reliant on oil from Canada. The reason is, in the 1970s, when the US was building its oil refineries, they were originally designed for oil imported from Venezuela, which is heavy crude oil, the same as Canada's. Pretty much all the oil produced in the US is light crude oil, and a lot of it gets exported. And to switch a refinery to treat light crude oil will take years, decades, billions of dollars, new workforce. These things just don't get switched on overnight.
How do you think NdPr prices will trend in 2025? Most new projects all use $100 kilogram as a prospective price for their modeling, but it hasn't been there in years, and EV sales have been declining over the last few quarters.
Yeah, so EVs are only part of the story, rare earth story and NdPr story. Having said that, I would not model anything with prices above $50 per kilogram. If it happens, great, but it's not going to last either. There's sufficient capacity still at this moment. I think what we are observing in this market is that there is a bit of a premium for unprocessed concentrate that shows that there is not enough raw material coming into the Chinese market that may be related to the war in Burma. It's hard to say. So there is certain deficiency upstream in this market, but we haven't seen much of an impact on the prices. The prices improved a little bit late summer last year, but we're far away from hundreds. So I wouldn't be buying anything modeling $100 per kilogram price for NdPr.
With the dramatic pivot away from the green transition across Western countries, i.e. the Paris Accord withdrawal, collapsing EV mandates, demand, etc., do you think the demand forecast for critical minerals is still as robust?
It is robust, but you have to be careful about changing technologies. I pity those cobalt investors in the past, because NMC battery is definitely losing ground. Question mark about vanadium. It hasn't really played out for storage as much as we hoped for many years, although some recent news are encouraging. Overall, it's difficult to see a massive boost to build new coal power stations in the West as we see in China. So the question of the 1.5 degrees Celsius, that's on China, India, Indonesia, and Russia, which are the biggest CO2 emission countries, not so much in the West. So that's where the focus should remain.
Great. Well, I think we're about out of time. So I just want to give you guys a chance to offer any closing remarks before we wrap up.
I think it's definitely an exciting space to be in, and it's not just demand supply of these minerals; it's where they're located, the geology, the metallurgy, the community, the infrastructure, the geopolitics of the region, the permitting regime. So, a lot of moving parts in the sector, and it's good to see that it's catching the attention of lots of people.
I think it's a topic that's relatively complex. You often find headlines and articles in generic press which really do not give you shouldn't be giving too much credence to what you hear about it. Critical minerals it's a long list. It depends from one country to another what is considered critical, and the approaches change. Unfortunately, they seem also to change with the changes of governments in different countries. So it's a moving target, which is probably one reason why it's also exciting to watch.
Great. Well, thank you both for sharing your expertise, and thank you to all of our participants as well as our partners at Coherra for making today's webinar happen. A replay will be available following the webinar, and you'll see contact information for Tomasz and Stuart up on the screen now. So feel free to reach out. You can also visit our website at AMVEST-TERRADEN.com to learn more about our ongoing work. And we'd certainly love to hear from you. We look forward to seeing you at the next one. Thank you again, and farewell.